Audio test. Testing 1, 2. Man, having problems with these. Am I coming through? We are just chopping here. No, this 5-minute bar should have had follow through. It's just producing tails. Kind of crazy trading today, so be careful. If we flip to the New York Open, we try to close this gap. I don't think they want to leave this gap open before we drop. So we gapped up here previous day and just we closed it, and the rest is history, right? Same thing the previous day, gapped up and down. But I think we're going to close the gap eventually. I think, well, thinking will get you in trouble. Yeah, this bar, I mean, if if it closed, it would have closed it, closed this gap, but it just got slammed down. So we'll see, but I'm done trading for the day, just watching the markets here. Let's take a look at the other man, it just doesn't want to go up. The indices, S&P. How's the Dow Jones doing? Dow Jones. What the Russell? Yeah, this should have had more follow through with this bar. But this 20 just slammed it down. Yeah. So we'll see what happens. Let's take a look at the crude oil. Gold. Silver. Oh, look at natural gas, up 8%. Started early in the morning. Nikkei, and corn needs to be Anybody trading?
risk position. NVIDIA and Broadcom. Joanne Feeney joins us, Advisors Capital Management Partner and Portfolio Manager. Joanne, great to see you. You've been making some of these moves over the last couple of months?
Yeah, that's right. Obviously there's been plenty of chatter about these coming tariffs, and the president of the United States has the power to impose tariffs, doesn't need congressional help there. So we've been pretty worried about this. And so in our balance strategy, which is designed to be relatively conservative but still deliver good growth over years, needed to have taken a little bit off the table. So we did that over the last couple months. We reduced some of our technology positions, didn't sell out of those, but just reduced exposure. They had a great run. And we added some safer positions, positions that create income, whether that's in Altria. We also continue to really like some of the healthcare names like AbbVie and Johnson & Johnson. It might be boring to be in some of these names, more utilities like Duke Energy. But right now, in this environment of elevated policy risk, not just the tariffs, but also potential government shutdown and global political risks, we think it's wise to just shore up the defensive side of portfolios.
How long do you envision this shift to safety might last, Joanne?
Obviously, we're going to be sensitive to the changing political dynamic. We don't know if these tariffs on Mexico and Canada, China, and potentially new ones on Europe, we don't know how long they'll last. But if the administration wants to engineer a change in manufacturing, that means they're going to be around for quite a long time. And so it's not clear one wants to run back into industries that are in the middle of that. Nevertheless, we still think there's opportunities here for growth, secular growth from AI, from cloud, from cybersecurity. Those things will remain even in a tough environment like the one we're now facing.
I see we're showing some of your moves into Broadcom and NVIDIA. I mean, we are still, even aside from the tariff discussion, dealing with the DeepSeek wrinkle, the maybe lack of ratification on whether these CapEx dollars are going to at least be high margin businesses. Explain why that trade makes sense.
Yeah, we've owned Broadcom for 10 years and NVIDIA for quite a while. So we don't this point raise our positions in those, but we are pretty confident that that growth run is going to last for a long time. Even with something like DeepSeek, that technology was known around the industry before DeepSeek hit the public awareness, and it doesn't really change the narrative. It just means that if you have better and better chips, you're going to be able to do even more. And that's why we have not seen CapEx cuts from the hyperscalers. We see them doubling down. We see Blackwell, the chip from NVIDIA, still in a shortage position and just ramping, and a new one coming at the end of the year. So we do see that as a really strong secular growth opportunity. In fact, if you look at NVIDIA shares here, they're cheap relative to their growth opportunity and relative to the market. So if you're not an owner of NVIDIA and you have a sufficiently long-term perspective, that would be one to take a serious look at this point.
Yeah, you're not the only one today. Citi as well reiterates their buy on NVIDIA as we bounce off 109 and change. Important day, Joanne. Appreciate the clarity and insight. Good to see you. Joanne Feeney.
You bet. Take care.
As we head to break, here's our roadmap for the rest of the hour. The read on retail. Target and Best Buy both out with earnings, both seeing sharp declines. We're going to break down the numbers.
Plus, tech's tumble. The Mag 7 continues to underperform. NVIDIA, which we're just talking about, that's the lowest level those shares have seen since September. We'll discuss, of course, if there is more pain ahead.
And the Canadian Prime Minister Trudeau, big press conference this hour. We'll take you there live when it happens. As Squawk on the Street continues after this.
Market is deteriorating as we speak. The S&P is now down almost 2%. Almost every sector is lower except for consumer staples right now. The declines in financials, wow, down 3.6% as a group, but some heavy selling in some of these names, which were thought to be big beneficiaries of the Trump trade, deregulation, pro-growth policies, all that. Not today. And consumer discretionary is right down there with it, down 3.4%. Tech is getting slammed as well. The Nasdaq's down 2% right now for the week, and it's only Tuesday. We're down 4.6% on the week. I mean, it has been a challenging few weeks here, and those losses are really starting to pile up. Buying of bonds with yields sharply lower. Retail's in focus as well. Investors are working through the tariff impacts and also new numbers this morning out of Target and Best Buy. Consumer discretionary, one of just two sectors now in the red on the year. Here to break it all down, Michael Baker, D.A. Davidson analyst. It's good to have you, Michael. Clearly, tariffs are front and center, and that's got to be part of the selling today. But what about what you gleaned on the consumer from both Best Buy and Target?
Yeah, and I'm here at the Target meeting today, and what we're hearing today is very similar to what we heard from a couple of retailers last week, which is really strong fourth quarter. January, okay, but February has seen a big step down, and that's a function in some ways of waning consumer confidence because of tariffs. Also, the weather wasn't great, and February isn't a big month anyway. There's not a lot of call to action, but really that's what we're seeing here is a combination of a weaker February and the tariff uncertainty. I
guess one thing that Target and Best Buy share in common is consumer discretionary exposure and exposure to categories that have been weak, like home, for instance. I mean, Fidelity did tell me that they were seeing better results in apparel, which had also been weak, and in hard lines, which is also part of consumer discretionary. But are these two unique in that sense compared to the rest of retail for what the consumer is going through right now?
Well, it's the idea that discretionary categories might get hit more in a tariff environment. Both Best Buy and Target told us they're going to pass pricing through. But that will probably or could definitely hurt units, and that's the issue. That's what Best Buy said this morning, is that tariffs could hurt them by at least 1% on the top line because they will raise prices, but they expect at least a bigger offset in terms of units. So the discretionary categories, again, Target and Best Buy aren't alone in that sense, but they do have higher exposure than, let's say, Walmart to discretionary categories. Those are the ones that presumably get hit a little bit more.
Can any of these companies buy more stuff in the U.S. to avoid more tariffs, or is that just not possible in these categories?
Well, it's buying in countries other than China, Mexico, and Canada, and that's been a trend that's been happening. But to move outside of those countries and to move more in the U.S., that takes a long time. I think that's generally the idea over time, but that can't be done this quarter or this year.
Do they have any alternative but to raise prices on consumers? And what does that look like in this kind of environment?
Well, the alternatives are to push back on your vendors as best you can. And the bigger you are as a retailer, the bigger pencil you push, the easier that is. See Walmart. We think they'll be successful at that. The second alternative is to eat some of the margin. And I think that's the concern. And that's what you're seeing in the stock today. And the third alternative is to pass it through. And that's where you could see a little bit of a hit on units. So that's the other issue, particularly for discretionary retailers. Again, the non-discretionary type retailers, the warehouse clubs as an example, Walmart should have an easier time not seeing that unit degradation because they're selling needs rather than wants.
Really quick, because you are at the Target meeting, I know they're laying out all sorts of long-term initiatives and flashing new partnerships. They just did one with Authentic Brands as champion, for instance. They're going to open new stores. They're going to lean heavily on digital, which performed well in Q4. Is there anything you're hearing that makes you a buyer on the weakness today and what we've seen from Target lately?
Yeah, well, sure. That story is all very positive. And let's remember, 2024 was a difficult year, but they ended up making their full-year guidance towards the low end of the comp. But they were in line with what they said a year ago. They had a really good holiday season. It's been volatile in terms of the quarters, but things are going reasonably well, with the exception of February and now the uncertainty of the tariffs. But longer term, yeah, we think they're well positioned, particularly where the stock is now. I mean, it's going to be trading at a pretty significant discount to the long-term historical average.
Okay, Michael, thank you for jumping on. Newsy day for us here. Michael Baker, D.A. Davidson. As we look at the Dow now, down more than 700 points, Carl.
Yeah, not too far from that 200-day, about 25 points away. Check out some of the big laggards. Best Buy, that's the worst session for Best Buy since 22. And then to David's point about the banks, even some travel-related names, Royal Caribbean down 8. When we come back, how the tariffs might change the Fed's thinking on rates in a minute.